Gopi, can you confirm the screen is on? Okay, okay, right. Thanks. I think we shall start, right? Okay. A very good morning to all. Thanks for joining. The idea behind this topic is since we have been having a very relentless bull market for last roughly 17 to 18 months, right? Started in the end of March 2023. Obviously, we have been having a mega bull market from COVID low, but I think there was a pause between November 21 to March 23, and then the rally started from March 23, and as we speak, it's been a one-way street. Hardly we saw any meaningful correction either in the large cap, mid and small cap, and it's been a relentless bull market. So obviously, these are good times for those who have invested for last 3 4 years. We have been fortunate to make capital more than what we thought about it. But it's also a very important time which we think as a house. How do we think about risk? What are the primary risks which we should be aware? And obviously, how do we reduce the risk, right? So that's a topic. I'm sure in the next half an hour to 45 minutes, I'll quickly run some relevant points, some framework we refer to, how we think about risk. And obviously, we'll open the floor for question in the end. To start with, before getting into the risk, let me share the big picture about the growth and how corporate India has just delivered numbers. Obviously, by next month, we'll be doing a full-fledged corporate India presentation. But then I'm just going to give you a glimpse of how Nifty 50 numbers have been panned out. So the big picture is we're in a very fortunate place. And I think no better data than this picture reflects how India GDP rank is moved from 13 to currently we are fifth rank in terms of size. We are followed by like US, China, Germany, Japan are the four large economies ahead of us. In the next 3 to 4 years, the journey is we will become number three, right? I think the context is in every conversation of allocation of capital in the world, India will be spoken. India should be considered given the size we will attain in next 3 to 4 years. And I think that's a relevance. So if we are a bull in next 5 10 years, right? I think this is one thing we should be keeping in mind why we need to stay invested in the markets, but at the same time, we should keep navigating between a high risk segment to low risk segment. With this GDP growing, this is a very interesting data or a chart put out by Mahindra Group recently. They had the entire management spoke about what the vision for the company. But I think this interesting slide captures where India is going to grow. So if you see the last 20 years from a 1 trillion to a 4 trillion economy, we predominantly grew by a lot of service business. But I think the next growth from a 4 trillion to a 30 trillion, right, which is what 2047 vision target, we are going to have a lot of manufacturing led growth. So India GDP will approximately will go 8 times in next 24 years time. 23, 24 years time. But if you see manufacturing GDP will grow by 16 times. So clearly reflecting, if you have a very long-term outlook and want to participate, one area going to give us tremendous opportunity in multiple time frame will be manufacturing. The second one will be exports. I think we are going to be a lot more export driven economy. That's how you're going to grow bigger. Every large economy, probably excluding US, which is more of a high consumption economy, have used export as a big tool to become large. I think we are also going to become a very large export driven economy, and that's going to grow 11 times vis-a-vis the aggregate GDP of 8 times. The third big mega trend, which we also believe is going to drive growth, is the women participation, which is going to more than double in terms of percentage, right? So from a 20% to 45% of the women going to participate. And that's going to bring a very different set of opportunity, which we never had in the past. So having shared the ranking and the prospect, this again an interesting data from NICA presentation where India is not one India. So the aggregate, if you see on the left side, the aggregate per capita is roughly between 2,700, 2,800 based on current numbers. But if you look at different cities, right, like Mumbai, Delhi, Kolkata, they are all very close to 10,000 above per capita, and even Chennai is 6,500 per capita, right? So if you find companies which is only serving a very niche market, could be as Chennai or a Bangalore or a Bombay, right? For all the right reason, your per capita is $15,000 and not what 2,500 for India, right? So I think as an allocator of capital, again, from an investing point, the opportunity lies in micro data, not always in the macro data. India is very diverse. If you see India, West and South is far more prosperous by wealth. So the next big development will happen in Northeast, North, and maybe a Central, right? So that's a core area where an incremental growth will come from infrastructure and a lot of efforts by the government. But if you have to look at the value or a stock of net worth, is predominantly on the coastal belt, which is South India, and on the west side. So having spoken about the ranking, which is the positioning will happen in the next 20, 25 years, which part of India GDP will be much better growth. Third, how different states can give you a very different opportunity. Now let's see how the Nifty numbers are panned out. As we spoke the day before yesterday, the numbers got out. So this is the first time I'm publishing this number. I think the aggregate Nifty 50 profit pool is 8,19,210 crores. So which has grown from close to 2.5 lakh crores in FY14, right? So I think we have been consistently growing. This is the TTM numbers where the last 12 months has been aggregated. We have colored the picture in green in some names, which is basically 24 out of Nifty 50 company have reported the best profit ever in the lifetime just now. These numbers have been highlighted in the green. So if you take HDFC Bank reported the best profit in their lifetime just now, similar to State Bank of India, similar to TCS. So the good news to be optimistically positive in the medium term is corporate India is delivering numbers, right? I think any long-term investment is a pure function of how corporate India is performing. For us, luckily, corporate India is performing steadily and quite robustly. And I think the same number getting reflected in the Nifty EPS. So one of the question keep coming to all of us is markets are not corrected. Why? The one of the primary reason is earlier there used to be an estimate for 2 years, and as the result come, the estimate number goes down because corporate India doesn't deliver numbers, and eventually the estimate get revised downward. But off late, if you see, the estimate number is either slightly moved upward or neutral. So let me give FY26 EPS estimate when we started off, which is in June 23, this number was called out first time, is 1239 on the left top bar. This was around 1230 consistently, and off late it moved to 1260. By May 24, the number moved to 1260. So the number actually revised upward, reflecting corporate India perform. Currently, as we speak, the number is 1246, slightly down. But on overall trend, you see a very stable projection numbers are being held on. It reflects corporate India is delivering the numbers. That's why we are not seeing major correction. Those who anticipate a very large correction in a large cap, they might be in for a disappointment because underlying fundamentals are extremely robust. So having spoken about the long growth, where the growth is going to come from and how micro markets and the results, now I will get into the core topic, which is the short-term challenges. And I think these challenges are real. The good news is we have to digest and then see how our portfolios are well positioned. So I will be speaking on 7 top risks which we think every investor should keep in mind to assess their existing portfolio or even allocating capital from today. So the first risk is the risk of narration. There is a strong narration that high, strong GDP growth is a reflection of good markets. I think for a very long period, it holds good, but in an intermediate period, it might not hold good. So this is a very interesting data from Kotak Institution has put out where our GDP growth typically tend to rally between 6 to 7% for long periods, right? There will be a very short period of 10 all because of low base, but generally our real GDP is roughly between 6 to 7 for a very long period. But if you look at this red graph, which is a rolling 1-year return for Nifty, which is oscillated between high positive return of close to 40 and even a negative return, maybe close to even 20%, right? Reflecting market performance in the short term, which is 1-2 years, has a very low correlation with the economic growth. So if we believe because of India growth is going to be strong, markets will not correct. I think it's a big misnomer. Market can be sideways movement for a very long time. And I think this data beautifully points out that in the short term, which is 1 to 2 years, absolutely there is no correlation between long-term economic growth and short-term market performance. The second risk, which we think less spoken, but I think definitely those who are keen observer of market is observing is competition risk. I think competition risk is always there, but the intensity of competition risk goes up when you have a very strong balance sheet, because the moment you have a lot of money, it is ideal for someone to expand the business. And if you don't find enough value in your own business, you end up entering into new business. So I will share a couple of data how competition can hurt portfolio stocks. So if you see currently, right, a large cement company conglomerate entered into paint, paint company entering into abrasive, tile company like Kajaria entering into bathware. So you're seeing many industry where everybody is trying to do everything. So I'm going to run through a small case study how in the past in the telecom, how telecom competition made a particular stock. Obviously, it's Bharti Airtel. All this conversation is to highlight the risk and not particularly on the idea. If you look at Bharti Airtel, right, for a 20-year period, the stock delivered 14 times vis-a-vis market delivered 10 times, which is not substantial, right, for the credibility of the brand. Definitely a great service. But I will get into the next slide, which clearly reflects there was a phase where Bharti did extremely well against the market. There was a very long phase, Bharti did extremely bad against the market. And currently also they started doing, and why. So this is a very interesting format which we keep capturing how one stock did against the market. So I'll tell you how to think about this data. Year 2005, on the first year, Bharti outperformed Nifty by 23% on a compounded. So this is compounded after year one. Year two, on a compounded basis, Bharti outperformed Nifty by 33%. So clearly, Bharti Airtel was a big winner in year 2005, 2006. And slowly, if you look at on a fifth year, right, from 2005, the outperformance has come to 5%. It means, and on year 9, the outperformance has gone to 0. And actually on year 14 from 2005, which is 2019, the Bharti stock from 2005 to 19 underperformed Nifty. And eventually by 20 years, which is FY24, Bharti actually has done 1% more than Nifty, right? So clearly, there are three phases for Bharti Airtel, right? As an example, one, there was a great phase. This company did extremely well. There was a phase where the company lost all the outperformance, went into underperformance vis-a-vis broad market, and finally they caught up. And I'm sure if you play back what happened, Bharti gained market share, did extremely well, and finally Reliance Jio came, right? Competition from a big guy. Definitely, even though it's a great company, you cannot defend competition like Jio, right? Jio really gained market share in the last 10 years, and that got reflected for the period from 2009 to 2016-17, right? Bharti terribly underperformed the entire market. Off late, because of consolidation, again, you're seeing Bharti doing well. So the whole message out of taking this example is great company like Bharti, which has a steady cash flow, serving 40 crore Indian population across the length and depth of the country, right, has had a phase of outperformance, had a phase of a very long underperformance, again had a phase of outperformance. And this underperformance period was close to 10 years. Why it is very important is whenever in any sector, a large competitor puts up capacity and try to, right, we need to be very mindful. The pain could be longer than what you and I think in the beginning. So that's the whole idea about this data. Now, let me take a practical example, which we are monitoring it closely. And we don't have any position in Asian Paints in our funds, but then we want to measure this. Is a great company, did extremely well. But if you look at the chart very beautifully, right? Last 20 years, Asian Paint outperformed benchmark by 12% CAGR. Outstanding outcome. But if you look at off late from 2021, this is one stock has not delivered anything in this bull market, right? And clearly reflecting there is a concern in the market. And having experienced Bharti, right? Any investor into stocks where there is a severe competition, I think we should be mindful. Competition is not going to go away easily, correct? I think Airtel stock, Asian Paint stock is clearly reflecting how from year 2021, the stock is underperforming, or even from 2019, the stock underperforming close to -4%, right? Clearly reflecting it's no more leading the market, it's actually lagging the market. So all good stocks, if we overpay and then competition comes, I think no better example than to study Asian Paints. And that's why I thought I'll put out this data to all of us. And if you look Asian Paint against Grasim, because that's where the fight is happening, Asian Paint always used to be a better performer than Grasim for 20-year period. But again, in the last 5 years, Grasim as a stock has done better than Asian Paint, clearly reflecting market is feeling the heat of severe competition. I think anyone who wants to allocate capital in this industry, we should be mindful of what happened in Airtel and what's happening in Paint, and we should keep the data and take an informed decision. It doesn't mean there was no time to buy Asian Paint. Answer is no. If the valuation corrects significantly and if Asian Paint is able to fight back extremely well, there will be a point where Asian Paints will turn to be a great company. But the whole point of sharing this data is every great company will be tested. Capital markets are brutal. The moment you see competition and ROE eroding, the price reflects, right? So that's where I thought this data is interesting. So we have spoken about two risks already. The third risk is the competitors and ecosystem listing risk. It means earlier, if you had to allocate capital to a passenger vehicle industry, right, the best way to buy is Maruti Suzuki because that's the only company capturing a very good growth of passenger vehicle. But if you have to look at today, right, in the last 6 years, 6, 7 years, a whole gamut of this entire industry got listed, right? From Hyundai has just filed, and right, it's going to be a question of a time. Hyundai will get listed, which is number 2 passenger vehicle company in India. Tata Motors, which used to be heavily dominated by commercial vehicle and a poor performance of passenger vehicle. But I think from next year onwards, Tata Motors PV will be listed separately. That gives you a window. M&M, which was earlier a tractor company doing SUV, today an SUV company doing tractor, right? Clearly reflecting the value lies with SUV today. It's a great option. Potential listing of JSW MG Motors should happen. Dealers like Landmark, Popular is got listed recently. The insurance, which is very focused on auto, like Go Digit, Lombard, is also listed. So when you allocate capital to any company, if the entire ecosystem gets listed, right, the choice for the money to go will go wide. I think we should be aware. I think one of the risks playing out in the banking sector is very similar here. 10 years back, there was only private banks or PSU banks to play. Today, you have wealth management listed, asset management listed, life insurance listed, general insurance listed, platform listed, exchange listed, zero broking companies listed. So I think the choice hurt some sectors. So this is the third risk, which we are very mindful when we allocate capital. So again, right, there's a data to support how the peer sets are very large enough. Hyundai, which commands today 15% market share. Tata Motors, which used to command 7% market share in the past, currently commanding 14%. Mahindra from 8 to 11. Kia from 0 to 6. So I think this entire ecosystem will give more opportunity, and we need to be mindful when we buy stock. We should adjust all this risk and then buy at an appropriate valuation. That's a more important message I'm passing on. Maruti, great company, doing extremely well. I think their entire fuel technology is a really appreciated things. But every company, you have to pay right price. And when such disbursement of competition get listed, you should be aware about this new risk emerging. The fourth risk, which has been called out in newspaper also for quite some time, is the promoter selling out, right? It could be an MNC promoter typically selling out the stake. We saw recently Whirlpool, Timken, Happy Mind, ITD Cementation, a lot more company where promoter founders itself selling, reflecting some bit of a overvaluation in some segment. And what this risk brings in is the volatility in the short term. So I looked at the data for ITD cementation, how it experienced a huge volatility during the selling phase. The stock fell sharply over the benchmark. And then obviously, in a good company, the good news is over a period, the stock will recover. But the bad news is you have to observe the liquidity. And if the company is not doing well in the near term operationally, the liquidity observation will take time, moving from a weak hand to a strong hand, and that will bring more volatility in the stock price. The second stock is Whirlpool, experienced a very similar journey, started falling before the announcement went to happen, and slowly recovered because of operational performance. I think when you buy into stock, we should be mindful if the founder or a PE investor who owns a very large stake comes and sells out, right? That's a risk which we should be mindful given current valuations. So this is a fourth risk. The fifth risk is not a significant risk as of now, but we need to be watchful because slowly you're seeing corporate India is getting into the mood of M&A. Since everyone's balance sheet is an extremely good wicket, there is a very high chance a capital allocation error can happen in the cycle. Um, we are just seeing a traces of capital allocation decisions are done by the corporate. Obviously, in the medium term, 3 to 4 years, we will get to know how good the decision is. So if you look at recently, Ultratech has been doing a couple of acquisition in the respective space. As I told in the earlier, Grasim entered into paint. Grasim, the other company is entering into a different business like jewelry also, right? So suddenly corporates are finding far more new industry to allocate money or buy out their competitor by paying the price. We have to be watchful. These are very large decisions. And in the past, we saw few corporates had an underperformance of 5 to 7 years because of a bad decision in a capital allocation. We need to be mindful. And these are very early days, right? Mankind recently bought a company for 14,000 crores, right? So clearly reflecting, these are not very small decisions, and we have to be very, very thoughtful. The last before risk is the earnings growth slowing down. I told in the beginning, earnings is growing, but it's going to grow at a slower rate. So post-COVID recovery, the growth got bumped up. So Nifty EPS growth happened at 24%, then 31, then 7 and 18, right? So very robust 4 years of a growth, but we are sitting with a very high base. As we speak, market is expecting a growth of close to 15% for FY25 and 12% in FY26. I think one, these numbers can be revised downwards slightly. Second, it also reflects the growth is going to come, but at a slower rate. That is where it's very important to take a very, very important call about where are we in the earnings cycle, where are we in the valuation cycle, and how is our portfolio is positioned. If there is excess risk, it's time to rethink very hard because growth rates are going to slow down. And the final risk, which I'm sure a lot of us have known, familiar, been contemplating how to do, but I think the data is very obvious. There are pockets of market which is today having high expectation of earnings growth, and any disappointment there can have a huge repercussion of the permanent loss of capital. So I'll take one data, which is the light gray, which reflects out of BSE 500 company, what percentage of a company trading at 5 book value, reflecting very high growth expectation in the particular stocks. So during 2003, there were only 15% of the BSE 500 universe, which is roughly what 75 companies had traded at 5 book value. During 2008, right, in the peak, if you see in the fall, right, or in the peak, which is 2007, 37% of the company traded at a very high value, right? Clearly, we saw what happened post 2007 when the market fell. A lot of stocks corrected by 50, 60, 70%. And if you look at 2017, right, after 10 years, a very similar incident where small cap rallied significantly. At that point in time, it was close to 50% of the BSE 500 company traded at 5 book value. Again, we saw a correction for a 2-year period. As we speak, this is a month-old data. I think the number has only just gone up. 55% of the company today is trading at 5 book value and above. This clearly reflects a very good section of the market is trading at a very high premium to the historical average. Even though some growth numbers have improved, the expectation has gone extremely high. We should be mindful of this expectation and be a little more prudent because with high expectation, any disappointment in corporate numbers or the macro risk can have a very strong underperformance period for next 1 to 2 years. Again, a very similar in terms of typically small cap used to trade 30 to 40% discount to large cap. But if you see currently, right, small caps are in times are trading at premium to large cap, reflecting the market is very buoyant in small cap and large caps are very benign, right? So there are pockets of market like large cap, banking sector are very cheap, and pockets of market like a small cap, micro cap is extremely superbly priced, highly priced. And SME, I don't think there is any comment. Very difficult even to value any SME companies, right? So to give some example of how valuation can hurt, this is a very great example which I keep referring from our framework, how Walmart as a stock performed for a very long period, 50-year period. For the first 20-year period, the stock did extremely well. It went up 1400 times. But as the valuation became excess, right? Currently, last 23-year period, obviously this data is slightly dated by 2 years, but it reflects what happened. Last 23-year performance is only 2x. Obviously, we have also not included dividend, which will prop up slightly better. But the big picture is, even the greatest of company, if you overpay, the value we'll get for next 10, 20 years will be suboptimal. I think that message is clearly called out. A very similar data on an 18-month rolling period, why you cannot be buy and hold every point in time. This company is a real estate company during 2007 cycle, went up from nowhere to 70 times upward. So on an 18-month period, an investor made 70 times, significant. But if you see that return is not sustainable, the stock fell. At the low point, the stock fell 80% from the highs, reflecting the gains was completely eroded. So the message to our people is, in companies where you make excess money, always buy and hold doesn't work, right? If the return is too good and too short period, taking some capital out of that asset might be a wise decision. And this example reflects that. The another example is this is a defense and aviation stock. As of last week, I looked at how the stock performance on an 18-month period. This stock typically rallies 300% or 400% and then goes down by 150, 60%. So if you see a lot of company in your portfolio, in a lot of portfolios, right, this type of a behavior is displayed. Companies are performed by 100, 200, 300%. And people think, okay, this is going to last ever. But if you just see the past data, right, this is a very long data, close to 20-year period. Never ever this performance is sustained and actually dies down and it falls sharply, right? Reflecting again, in the bull market, let's not confuse between our luck and the brain. I think obviously hard work is paid rich dividends, but it's time for us to be a little more realistic rather than slightly greedy. This is another last stock. This is a PSU name. This 18-month is the best performance this stock ever had in the history, clearly reflecting the people have hit the gold spot, jackpot in terms of the performance. But again, going back, seeing the past data clearly reflect this is not a normal return for the stock. This is an extremely abnormal good outcome. So if you have made money, congratulations, but have a strong look at stocks which has performed like this without fundamental growth. Eventually, the stocks correct over a long period of time. I think with all this 4 data of Walmart, a real estate company, a defense company, and a PSU lending company, reflects one message is, I think we had a fantastic run. But if you look at the data in a very long period, very clearly calling out when the excess returns are delivered in a short period, it's followed by a long period of underperformance. I wish we take informed decision, seeing every company specific things, or maybe take advice from your good advisor to take a good decision. This is the last before slide. What to expect? This is of something which we as a house, we keep tracking and keep doing it. Over a long period, markets have delivered 11% CAGR. I think last 3 years is a more of an abnormal phase. The returns have been bunched up, very credible numbers. But I think over a long period, expecting 12 to 13% in the aggregate market is the right return expectation. I think next 2 years, if someone can compound capital between 12 to 15, I think it's a great point given the rally we have experienced in last 3 years. So the summary, moderate your risk levels of the portfolio now. See the portfolio dispassionately. See pockets of portfolio which get overexposed to small and mid cap, micro cap. Have a fresh look at it. revisit your holding with fresh perspective, given the sharp run up in few small and micro cap, and take necessary action to protect the gains. And finally, having measured the risk and the pockets of risk, and reallocate capital probably to a large cap or a couple of other sector where we find very attractive. The last thing is set realistic return expectation for the next 2 years, which will allow you to allocate more capital to probably liquid large cap, liquid very larger mutual funds, large cap oriented mutual funds where we see a lot more value. I think with that, I would like to conclude saying last year has been a good year. We have to celebrate the success, but at the same time, we should be aware of the risk and then take one or two very high quality decisions to protect the gain and to sustain the wealth over a long period of time. Thank you. Thanks for your time, and we'll be very happy to take questions. Thank you once again. You guys can put out the question in chat box. I'll start replying in next 2 minutes. Okay, my the first question is what type of analysis chart in the Bharti? So basically, the chart which we have reflected is how Bharti as a stock did vis-a-vis Nifty on a rolling period on any point in time. So that's an analysis which reflects was it good decision to own Bharti vis-a-vis market? And I think with the chart, it clearly came out right. In the initial period, Bharti was a better stock than Nifty, and a period where actually Nifty did better than the Bharti, and eventually Bharti caught up in 20-year period. But the outperformance of Bharti for last 20 years is close to 1%. JSW Paint, Brilla, Ops is a new competitor. Yes, I think there are a lot more competition, but obviously Brilla being a very large organization, they have committed large capex, clearly reflecting the price action of a lot of paint companies. Which PSU stock are you referring here? I think it's not a question of the stock name. The whole idea about the session is instead of getting into the names, right? Because the idea being to share these names or the topic is there is risk in some names which companies have done extremely well. Their performance is far credible today. We need to be a little more mindful. That's the whole message. PSU was one such example. I think there are a lot of companies where I can refer companies where the performance fundamental growth is 20 to 30%, but the stock price action is between 200 to 300% in last 2 to 3 years, right? I think it's not one segment, but I think PSU as a part rallied significantly, which was no go stock 2 years back. Today, there is so much excitement. That's why I thought I just referred one other stock. Hope I answered your question, sir. And big company not focusing on core business, diversifying to other sectors shows less opportunity margin existing business. Should we avoid such company? I think we need to be mindful. The diversification is not bad, but I think a reckless diversification is definitely bad, right? So we have to be mindful how your companies are behaving, why are they getting into, do they have right to win? And if you don't have a very conclusive answer, you have to ask a deep question, why are they doing currently what they are doing, right? If the valuation in most of the companies are too high, shall we consider that we can delay our investment coming to? No, I think sitting on cash is not an ideal solution. What I said is valuation in small and mid cap is expensive. But I think if you look at large caps, right, a very good value lies. If you look at sectors which is in the banking or stocks which are exposed to exports, or company which is are focusing on consumption or rural, I think the valuations are palatable. And I've also shared corporate India is delivering very good numbers. The whole idea is I see very good capital is getting recently deployed only in micro cap, small cap, given the past performance. I think that is a risk which we would request people to consider, because having seen this performance, the future return could be suboptimal. And if you're overexposed to micro cap or a small cap, it's time to revisit. Otherwise, aggregate market level is, I would say, maybe a 5-10% premium, but a growth economy like India for next 5-10 years, paying a 5% premium to capture a growth for next 10 years, I would suggest being invested into market makes a lot more sense. But at the same time, you have to move money from a high risk position to a low risk position. That is our point of view, sir. Hope I answered your question, Jay Kumar, sir. For the past 5 years, if I have a net seller, then who is buying? I think DIs are buying left, right, center. I'm sure you have been tracking the SIP flow. We have crossed approximately 20,000 odd flow of capital into SIP. SIP has become a major trend. HNI money is flowing in. So obviously, Indians are buying Indian companies. It's a good larger term trend, but I think we should buy very liquid name. So most of the stock price action is a primary due to less liquidity because of float. I'm sure at some point in time, regulation will come and tell the float levels have to improve. So be in liquid names, be in pockets of the market where the risk levels are low. Whether market will be sideways correction, I think it's a good question, but I don't think there is no easy answer. Sideways correction can happen, but given the economic growth and the fundamental growth, it might not be long period. We might have probably a 6 months to 12-month sideways market before we consolidate the excess and then we start pulling up back, right? But I think have moderate return expectation instead of anticipating what will market move, which is not in anyone's ability, definitely not our ability. Our decision is be in an area where valuation is affordable, where growth outlook is improving, return on equity is improving, and have moderate return expectation. That is our suggestion. What sectors do you think undervalued currently and likely to do well? As a house, we are pretty positive on financial, both banking and non-banking. That's one area. We have been very, very positive on life insurance, but off late that stocks have rallied. So we are reconsidering it, how to go about it. We are pretty constructive on few Indian companies becoming world champion. They are export-driven companies. They are doing extremely well. They have gained their competitive advantage. So companies facing consumer in rural India or very, what to say, high-end consumers still okay, right? Because the recent rally is something to do with policy-related companies that did extremely well. Consumer stocks have not done well, right? So I think there are definitely still pockets, but it is not a lot more. So to give you perspective, in our PMS, the day one deployment in most of the funds is only 20%, reflecting the current market levels. We are deploying slowly, and we are also advising our investor to come with a 4-year outlook with a reasonable return expectation. How will be ithought PMS deploy moving forward? I think I exactly shared the same, sir, Shipad. In terms of we are deploying very slowly. We are aware of the risk which we have called out as a house. We are deploying between 20 to 30% in multi-cap, small cap. In large cap, we are deploying close to 60 to 70%, reflecting large caps are far more reasonably valued today vis-a-vis small cap and the micro cap. Is Nasdaq is expensive range or fairly priced? No comments. I think we are not big bullish, having seen the rally with AI stocks where Nasdaq predominantly captured it. But I think there is a long-term index, and maybe I'm not the right person to precisely answer this question. Sorry. Is it right time to invest in True Blue with expectation post-tax? I think first, the return should be everything is pre-tax, because tax is something which I will not comment on, as tax rates also keep changing. But I think we are very happy, right? If someone having in the medium term return expectation, what you have suggested, I think True Blue perfectly fits the bill. It's a very high quality, India's first mega cap portfolio. with 2021 stocks of the finest of finest blue chips of India is invested. Truly long only portfolio. That's why the deployment today is close to 70%. But I think it should be a pre-tax return and not a post-tax. With inflow in SIP always hitting new high every month, do you think it will stop market falling, going up artificially always? In fact, how will the market correct? I think markets can correct in its own way. There are a lot of stocks. I was just seeing a data. Couple of different stocks in the last 1 month corrected 30%. So SIP flow is happening. Everybody is buoyant. Why stocks are correcting? I think market always move in cyclicals. They move in a cycle where there will be a sector which will be going up. Currently, if you see healthcare is having a bull run, then there are sectors which will go through a bear run, right? So flow can only support in the short term, but eventually, if the fundamentals disappoint, if the growth disappoint, or the macro risk becomes bigger, the price do correct. So taking support of flow and saying the flow is good, markets don't correct, I think in the short term it can support, but in the long term this can disappoint a lot of investors. But as you said, currently the flow is very strong. That's a risk which we think, right? The money is coming with a very, very high expectation. The next question is, should we book profit from stocks like defense, which has grown, given? I think my objective is not to speak on stock specifics, sir, but the whole idea is have a strong look at how your companies have done on the fundamental metric, which is sales growth, sales converting into profit, profit into cash flow into dividend. See the growth rate, see the price action, see what is baked into the valuation, and take a appropriate decision. Can this deck be shared? I think we will put out this video and I think you will be able to refer back and see it. Hope that is good for you, sir. Your views on equal weight index, please. I think equal weight index captures all the 50 stocks if it is Nifty 50 equal weight or if it is BSE 500, right? But index is a good way to capture the market performance. But obviously, right, index is also flawed. Reliance Communication was an index stock some point in time. So there are a lot of names. Sometimes index have weightage which is not needed for the quality of governance, quality of balance sheet. So I would always say a very good mix of having passive, active, equal weight, concentration, everything is needed to do a very good portfolio and not getting swayed by the market narration. 2 years back, the market narration was everybody will go passive, index is the way forward. Exactly 2 years out, a lot of funds have outperformed the benchmark. Index is struggling in a way. If you see mutual funds which captured this alpha, stocks have done extremely well, right? So I think having a balanced view makes a lot of sense, but I think equal weights are very good. What tool do you use to arrive 20-year matrix that show Bharti? I think we have inbuilt, this is a proprietary framework which we have built in-house. As a house, being part of a research team, I had the research and I also managed a couple of funds. We build a lot of process to see where the opportunity lies, and we need a lot of data, right, to form an opinion. So this matrix is built by our in-house team. Hope you like that matrix. Will our bull market be affected by US recession? I think our bull market, the big challenge is in internal, which is valuation, nothing to do with US. If we are very cheap and US recession were to come, right, we might be less affected. Since we are priced high, at least in small caps and micro cap, anything bad news coming out of the world is going to be really bad for us. I think I'll answer that way. Thanks, a great session. What is your advice on portfolio construction now? Does we take cash call? I think cash call is not something which I'll advise. Thanks for your kind words, sir. My suggestion is have a hard look at your asset allocation. Go back to your original asset allocation. Let's say you want to be 70% equity, 30% debt, go there. 70 equity, 20 debt, 10 gold, go there. Within equity, if it was 50 large cap, 25 small cap, 25 micro cap, go there. What I don't want to see is, I just happened to see yesterday's portfolio of a very large account where portfolio is extremely skewed towards small and micro cap today. So I think that correction is needed. Otherwise, India is doing extremely well. Corporate India is performing extremely well. Being invested in the market is far more going to be profitable than being out of the market, because no one will come and tell you when to come and deploy money. All you can do is move from low risk to high risk. And I think that's our suggestion. Sorry, move from high risk to low risk. Can underperformance in top few private bank remain as earlier price to book may not return? I think earlier might not return, but if you look at well-run company, one measure I always think gives you a very good data is the market share growth. I think a lot of private banks in India consistently gaining market share over the peers, reflecting their need to the society is continuously going up. And I think they will find their ways to capture that entire value into P&L. So we continue to like few private banks. Valuations are very, very palatable. They are compounding the book value by 15-16%. So those who want a very moderate return of, or I would say good return of 13-15, I think some of these names gives opportunity. From YouTube, please explain about the impact in mining companies on recent court order. I think we are yet to go through that. We don't own any mining companies, but I think like every business, you have to be aware regulatory risk in this industry is always high. So whenever you price an asset, you have to account this risk and then price it properly. That's all I can tell. Only mid caps can be the next large cap. If we avoid how we can multiply our growth, large cap growth has some limitation. I think that's a big myth, Ms. Karthik. When next month I'll be doing corporate India numbers, it is not large caps are growing slower than mid caps. If you look at a company like a Trent, I was just looking at a company like a Zomato, which is a very large cap, firing in all cylinders, right? So I think the growth is in all over the place. Definitely, the mid cap can have a little more better opportunity, but you have to also appreciate mid and small cap cannot attract right talent. They will not have larger capital. They will not have lending money from the banks big time. So if you see globally, large caps have done extremely well, right? Small caps have not done well. I think it's only believed that in India today, large caps not growing. If you see numbers dispassionately, there is equal amount of large caps are done extremely well like a mid cap company. I would say only that. And valuation in large cap is far more reasonable today. Mid caps, I find hardly few. And in small cap, it's even more difficult. Vijay, I have sir, there is no question called dumb question. Every question is a good question. If the most SIP flows are going to be small cap, shall we focus on large cap funds like contrarian view? I think have small cap, have limited exposure, have exposure which you are comfortable. You are willing to take drawdowns, but you can compound capital. Brilliant. I think today large caps are attractive. Based on your long-term goal, your need, with you take advice from your advisors. Large caps are finding far more palatable. And definitely, it's a view which we should form, contrarian view. But I think there is value in large cap. At least that's what we believe. Do you see value in any international markets? Or I think I'm keenly focused on India currently, where next 10-20 years growth is there. Being in AGM season, we are all over the place, attending a lot of AGMs to see which corporates are doing good job. But I think definitely, right, China is pretty cheap, but you don't know the catalyst. I was looking at yesterday one data on 30-year GSEC of China is sub 3. It's close to 2.5% types, right, from 4.5, clearly reflecting the long-term concern of the growth. But valuations are cheap, right? US small cap is cheap, but you don't know how to play it. So there are pockets where it is cheap, but I think primarily we are an Indian-based investing institution. One of our fund, which is peer in multi-asset, do take some exposure, and we have some exposure in the foreign, but not big time. We are predominantly in India. 1 second. Okay, there is a sector. The stocks have dropped 50-60%. The last con call promoter mentioned is the worst margin they can strike all the done of the quarter. But considering the cyclicality, building material could it be a good opportunity to take a view. I think if you are able to do research well and find value don't take 2021 as a peak, right? No, the company which I shared on the real estate, right, never came back to the peak for a 10-year period. So peaks are a point in time. Market thought that company is a diamond, and at same time, the same company when go down will become a dust. Whole point is take current valuation, see what is your 3-4 years earnings outlook, free cash flow, competitive advantage, and what is a fair exit multiple, and see if you think you're going to make more money than the market. I think you should take the trade. Or not on specific on this company, generally, right? Any opportunity you will evaluate like that. Women participation in workforce is going to go up. Which consumption sector? I think there are a lot of company getting listed, right? So there is a legging company got listed. So you will see a lot more new company will get listed serving women as a core customer. So I think the opportunity will open up. We need to be mindful. And if the moment more women is going to work, what will happen to utensil business? What will happen to dishwasher? I mean, a lot of new need will come up at the family level to balance the family. So I think every change in the society brings new opportunity, and that is where we need to focus. But this is a mega trend. In case of Vridhi, what should be the timeline? Is it okay to keep same or move? No, I think if you come to Vridhi, we have one thing I can be give confidence, sir. Me, my colleagues, all of us are very cognizant of what not to do. If again going back to Vridhi, the day one deployment is roughly 20-25%. We are only investing into pockets where we think there is more money to be made. But if you have a 5-year outlook, definitely you can stay invested there. But aggregately, if you are overexposed in small cap, including Vridhi, you have another 5-10 funds in mutual fund or all PMS only in small cap. It's a question of reduce your overall exposure to small cap and nothing to do with particular fund. If you are excessively overexposed to small cap or a micro cap, I think definitely you need to reconsider the decision of how much to come down. At least from our fund point, we are being very, very prudent and judicious, and I've told the number right. Between 20-25 is what we have deployed, reflecting how we want to protect your capital and grow your capital. Is Indian markets got enough depth as we chase the same set of 50? No. I think there is so much depth. So today, 650 plus company does con call. There are roughly 1,000 odd company with 1,000 crores of market cap. So the depth has got wider. Last 4-5 years, we got close to 200 odd company got listed. So I think we have very good depth. The only thing is the money is flowing in a very particular concentration because of the narration that to make money in the market, you have to buy illiquid small cap. I think that is something which we are not comfortable. The depth is definitely there. What kind of diversification outside of equity can we consider? I think we definitely have to have fixed income. We need to have gold. Yesterday, gold has hit again all-time high. I was looking at yesterday Merrill report on how asset class have performed globally. Gold has been the leading asset class across the world as YTD. And for the last 3 years, gold consistently performing, right? So having a good portion of gold. We are very proud to inform ithought as a house. We have been very positive on gold for a few years, and I think it's paying off to all our investors, right? So we should have gold, you should have FD, you should have fixed products which will give a stable return like short-term funds, which is on the mutual fund side, and obviously equity large cap. And then to top it up, you should have a small and mid cap. Informative, very thankful, thought-provoking. Thanks, sir. Kind words in defense sector. Some company management give guidance 40-50% growth. What's your view? I think this growth is now well documented. Valuations are reflecting. India grows at 10% nominal GDP. If a company has to grow 50-60% for a very long period, they'll become very big, right? So 40-50% is more of a misnomer, not a sustainable. No company in the world for a very long period have grown at these rates. So we need to be mindful, enjoy till it is good, but then you have to be mindful on this growth are not sustainable. Is pharma sector fully priced after the run-up? I think it should be stock specific. The easy money is done. In the result season, we clearly saw US came back strongly. The pricing environment in the US is pretty good. A lot of pharma companies done extremely well. Large caps have done well, mid caps have done well. Uh, but I think it's a good sector to own. Primarily, the demand is stable. Valuations are not terribly high, but yes, easy returns are done, I would say. Related to composite license insurance industry, what's your point? I think yet to come. Uh, the managements are well prepared, but globally it's not a big success area. But we have to see when it comes what the management. I think our bullish call is India 300 lakh crore economy, retail saves 20%, which is 60 lakh crores. With that 10%, close to 10 lakh crores of money is saved in insurance. And so it's a large capital of money get routed to a savings pool. And I think that's what our primary a long-term bull on insurance. And we will see when it comes in what form. US de-dollarization, recessions are impact to Indian export like IT, pharma. In this case, how should we invest in export business? I think you have to be case specific. Not if whatever recession, right? Pharma business you cannot stop, right? The moment we are unwell, we have to go to hospital, and once you go there, the hospital bill and the diagnostic bill and the medicine bill hits upper circuit. So I think that's a very defensive business. IT anyway, we are not very positive. You are rightly said the growth rates are very anemic. The stock price are all-time high. So we are not very bull on IT at this point in time. Even though we like the business model, we don't finding comfortable on the valuations. Whether sitting in cash is advisable or what? No, I've answered that. It's not a very keen strategy. We not recommend. What is the large cap percentage in solid PMS? So we are put together at the flow level. The new portfolio built is more than 50% into large cap. But if you look at our existing portfolio, we are at 30-35% into large cap because in solitaire, we don't own any banks and banks are cheap. So in solitaire, we can't own banks. So that portion of large cap, we cannot own it in solitaire. Second, we own 1/3 of the portfolio into MNC company, which are mega cap globally, but they are small cap in India. So what type of a company you own? So I would say at stock level, it's close to 30-35. At the flow level where we are building today, we are building predominantly large cap portfolio. Indian IT with the low growth prospect priced higher relatively compared to Nasdaq, higher growth, a better choice. I think not strictly comparable. Indian IT companies are very different to what Nasdaq companies are. Nasdaq company has a very different breed, right? There are a lot more variety you have in Nasdaq. Indian companies are very similar in nature. So I don't think they both are non-comparable in my view. And obviously, right, I would say in the long term, I think Nasdaq growth has been pretty solid to Indian IT base growth. But again, right, at what point in time you buy in? Nasdaq was a brilliant buy 2 years back when a lot of this company got crushed due to the Fed hike policy. And obviously, right, in the last 2 years, we had a dream run even in Nasdaq index. While understood, you will not comment on individuals, just wanted to view on recent bull run. Again, right, not stock specific. Every bull run backed by free cash flow, growth in earnings, future prospect growth is good, and valuations are in line with the historical average. It's good. Otherwise, you have to take a hard look at it. I'm sitting with a fund of lump sum right now. How should I go about towards wealth accumulation for long period? Keep revisiting your asset allocation. Don't drift away your asset allocation in the peak of bull markets. Be consistent with your asset allocation. Regularly invest. Have right return expectation. Have 4 to 5 year outlook. You will do very well, sir. Mr. Chiranjeevi. Hope I answered. Thanks, GRB. Great. Thanks, sir. Hope added some value. Thank you. How to start evaluation company. I think that's a separate session, Ram. We will do it. But one clue I can give, any company doing very good to the customers, I think be mindful. They might be a good investment in the long term. What is the percentage of cash position we have in one individual portfolio? I think that's a very individual specific. I would say in solitaire today, we are at 5-6% cash. So reflecting, right, you cannot be out of cash because it's a growth economy. It's a growth economy for next 5-10 years. So there is no better economy like in India. But I think you cannot be at 100% and you cannot be 100% in small cap. That's all I would say. But we are not a big subscriber of cash. To protect gains, I have been moving money from small cap over last few quarters, but this has led to a lot of interim gain loss. Wonder this shift was too premature. Sir, I think Arnachalam, sir, I think you have been very honest. There is no easy answer. You have to slowly move from risky zone to non-risky zone. For the time period, it will look premature, but you have behaved it well. You are preparing for bigger gains, I would all say. It is always wise to move from a risky portfolio to a non-risky, even though in the short term, we might lose some return. I think I would always do the same what you have done. So I appreciate what you have done. And there is no easy answer, right? The stocks will not fall the moment we sell. But I think it's always good to think about reduce risk and leave the last few gains to the market because maybe that's not for us. We are not the smartest people, right? I always believe let's not think we are the only smartest people. So we make money, we should be happy, protect the gain, move forward. Consistently do that over a long period. I'm sure no regrets, you will do very well. And you don't have to compare with anybody, right? Our journey is only unique to ourselves. I would suggest that. How much upside do you see gold? I think anybody's guess. We continue to hold. The macro risk is extremely vulnerable. If you want one evidence, go and read JP Morgan's recent result commentary where the CEO commented the political risk environment is highest post World War II. I think clearly reflecting we have to be mindful of the political risk we are experiencing, and the way to hedge the political risk is having gold. Is it right time to book profits for overvalued? 100%. The moment you are overvalued, you should start thinking about booking. Maybe don't sell everything tomorrow morning, but prioritize your selling. Keep selling steadily till you are reasonably exited the overvalued position. Thank you so much. Efforts, time spent, patience. Thank you. Hope I added some value. Thanks. What's your view on automotive industry? I think the easy run in automotive is again done. Post-COVID recovery, the stocks have done very well. We were a very big bull on a two-wheeler when the industry was pessimistic, and of late the market is rewarding the two-wheeler stocks big time. But from here, everything is heavy lifting. Primarily, the margin lever is out, the valuation lever is out. The only lever of growth is the growth lever, and which is going to be moderate in the volume of 5 to 6% at unit volume, with a mixed change, ASP change of 5-6%. You can expect a 10 to 12% growth. So it's going to be a decent growth, not a high growth phase. I'm a very customer-like approach. They are deploying cash. Hats off. Thank you, sir. I'll convey my regards to my colleagues. I strongly recommend ithought. Thank you. I think kind words, Mr. Mani, sir. We are fully committed to do what is right to make long-term good outcomes to our investors. That's our promise. Great session. Thanks, Shilpa. What about QSR space? I think we are actively pursuing reading, thinking. We don't have exposure currently, but I think it's one space has gone through a lot of pain, and we are very active in this space from a research work point of view. All I can say that. Great session as usual. Thanks, sir. Last few year returns I thought is good when compared to benchmark. As customer, we are happy. Thank you. Whether this kind of difference when compared to benchmark realistic, sustainable. I think thanks for the compliment, sir. My only thing is, I think we always endeavor to do the best to our shareholders. We'll keep our head down, stay down, do our hard work. But I would say last 5 years been a credible journey. We have done brilliantly well. We'll put our best efforts and hope to continue the show. That's all I can tell. And that's our promise in terms of we will put our best efforts. And we have the same team to do the job. Sham sir is advising in his YouTube cash position to invest where there's fall. What's your view? I think it's a very individualistic, but I would definitely concur with our founder, Mr. Sham. If you're fully invested and overexposed to small cap, having some cash makes sense, but not significant given the growth outlook. So it's a question of very individual call. I will not generalize the view, but definitely have some money, because if fall happens, a lot of us predominantly will be a salaried employee. So we get money once in a month and we need more capital to capture it. I think that will be the context. Without context, I don't want to comment. But as a fund, we are 93%, 94% invested. And but yes, it's a very individual call which you should take. View on sugar, ethanol, no exposure to commodity per se. But I think some ideas could be interesting, but not for the portfolio. We don't own anything in Solitaire or True Blue, where I manage or I assist Sham with the funds. Can you send me the recording of the session? It will be put on YouTube, sir, in a day's time. You will be able to see it. Omkara. By cash, do you mean liquid instrument? I think cash and liquid are same. Cash doesn't mean we put cash into bank account or savings account. Everything is same, right? And non-equity is considered as cash. Is the right time to now start with Virdi since it's a small cap? Yes, it's a small cap. The two caveats is come with a 5-year outlook. And you should see within your allocation, you are not currently overexposed to small cap and have a moderate return, good expectation. I think if you have all the three, you should deploy in Vriddhi, because we will do a very staggered, judicious deployment. I'm sure if you deploy in mutual fund, the day one deployment will be 100%. In Vriddhi, we are doing it roughly 20-30% on a day one, as I told. But you have to check at the beginning, are you overexposed or you don't have any exposure? So if you're not having any exposure or a minor exposure in small cap, and you have a 5-year outlook and reasonably moderate return expectation, definitely right, Vriddhi will do justice. And we have done phenomenally well in that track record, right? I'm sure you would have tracked it. Thank you. How would the oil and gas? I think we don't have, again, large exposure there or any exposure, but I think this is a very strategic sector. If we find any opportunity, we will deploy. But as we speak, we don't have anything major exposure here. As a PM Solitaire customer for years now, it's been a good return. Thanks, sir. Thanks to the entire team, GRB, Sham, I thought strongly recommend. Thanks, Vijay, sir. I think your kind words will keep us head down, stay down. We'll be very focused. And hopefully, with your kind ones, we'll keep growing the institution for a lot of years to come and a lot of decades to go. Thank you. It was good. Thanks. You have a very informative. Thank you. Will there be any immediate rejig on Vriddhi portfolio concerning? I think they are appropriately selling. We have been continuously selling where the stocks are overvalued. And I think the amount of selling done by today, my colleagues in small and mid cap is the highest in the last 4 years, reflecting where the valuations are rich, we will sell. There is no second question. But we will sell very calibrately so that the price doesn't fall because of our selling. View on gas, city gas, no big exposure. So no particular view on any company. There is GNPA increasing sign in banking credit. Your view on GNPA, what's a microfinance, small finance? I think the NPAs are slightly moderating. I think we had a very, very zero NPA scenario sometime back. NPAs are slightly coming back, but I think our banking balance sheet is extremely good. I'm talking about large banks, universal banks. Microfinance and small banks has to be case specific. We don't have any exposure to any of these names. Is debt totally due to taxation changes? I do not fully buy into focus only on petty returns. Tax is a way of life and we need to fact. Do look at it, but I think having a good exposure of debt and equity makes sense, because there are periods globally and India, 5-7 years equity underperformed debt, right? So tax is definitely an angle, but I think first protecting the capital is also important at some point in time, or a portion of a capital should be always safe. So I think in that construct, I share the view. It is very individualistic. I leave that to you, sir. How much debt you should have, or you should have zero debt. But I personally recommend having a balanced portfolio is a very good approach for common people, not case specific. Hope I answered your question, sir. I have Solitaire. Will it add to start Vriddhi PMS? Do it. I think it's again a question of what you want. Solitaire is a multi-cap. Our typical exposure to stocks will be close to 2,000 crores and above. Vriddhi too take exposure companies less than 2,000 crores. So if you have a 5-year, 7-year outlook, want to add a specific small and micro cap, Vriddhi is a solution. You don't want to take any call, want to be a little more conservative with a multi cap, Solitaire is a solution. Hope I answered your question, sir. What's your outlook on logistics sector? I think we are very positive. We have few names in logistics. India is going to become more logistic efficient industry company. Logistics is a pain point for a lot of sectors. And I think a lot more winners going to come out of logistics. We have a very positive outlook and we have few exposure in the sector. I think it's been a long session. Hope I have answered all the questions. I think with that, thanks for all. Hope we added some value to you. To end, keep compounding capital and let's do a good job. Thanks for your time. Looking forward. Good day.